Nasdaq hitting a record high today as investors brace for a big week of earnings and the election. Our next guest says concerns about the market being overvalued are misplaced, and that a year-end chase should push stocks higher. Let's bring in Warren Pies of 314 Research. It's good to see you again. Welcome back. Why shouldn't we be worried about where this market's trading?
Yeah, well, I mean, I think that everyone who's making a lot out of the valuations, and we've been there ourselves, are looking at this market compared to historical PE ratios or historical valuation ratios. And I just don't think that this market looks much like the quote unquote historical market that you see when you study history. So if you start by looking at the composition, what stocks make up this market? Over the last 20 years, we really swapped in a lot of growth in tech for a bunch of cyclical stocks like financials and energy. And so if you think about it, financials and energy, historic PE ratio like 15 times, tech's like 20 times. And so just by that swap, you can, in what we've done is hold the current composition of the market steady through history, and then come up with a new PE ratio. And that's gives us like a 21 times trailing PE, but we are at 26 times. So we're still slightly overvalued on that basis. But if we look out and we think of other factors, there's some quality factors that I think make this market more attractive versus history. Consider return on invested capital. We're double where we were 20 years ago. Margins are expected to expand, and the margin expansion that you see out of these secular growers, those tend to push up multiples. So when you add all that together, our view is that it's kind of a fallacy to think that just take that straight up PE ratio and conclude that the market is overvalued. Put all that together, I think we're about fairly valued. And if we get the analyst estimates, which is like 26% from the end of 24 out to 26 of earnings growth, I think this market's set to go up above 7,000 by, let's call it 2026.
But I mean, at some point, you say not you, but there's been this thought that you can tolerate higher multiples much, much easier in a lower rate environment. And the thought was that rates were going to be coming in and that earnings were going to be able to sustain the multiple that the market was trading at. But if we're thinking now that maybe rates are going to be higher for longer, doesn't that pressure the multiple at all? And that doesn't even begin to address the earnings question, as estimates have come down. They're still good, but they have come in.
Yeah, to me, the two big risks when we look out the next year are valuations and rates. And like you said, they're kind of mixed together a little bit. And we've done a lot of work, and I just went through our really high level thoughts on valuations. But, when I look at 2025, I'm starting to think of themes for 2025. And one of them is, can the U.S. economy deal with 7% mortgage rates? Because it's going to be difficult for I think, the Fed to move rates much lower. So it's a real risk. At the end of the day, though, growth cures all these things. And so one of the things we did is we looked at what are analysts baking into the top line growth estimates for this market. It's like 12.5% out through 2026. You can basically run that against nominal GDP, and it equates to 5% nominal GDP environment. So if we can hit those growth targets on the economy and on the top line, ultimately that's going to power this market. Even if multiples compress a little bit, we should have very solid returns out through 26.